Welcome to Upticks. I'm Jake Falcon.
And I'm Corey Bittner. We're the founders of Falcon Wealth Advisors and your co-host for Upticks.
Today is our 29th episode, Bad News Bears.
We're going to talk about a bad year for your financial plan. We're going to talk about questions worth asking and income investments.
Okay, Corey, for our financial planning portion of today's show, we wanted to discuss what happens to your financial plan when you don't hit the target rate of return. Maybe you can cue in our audience a little bit, or clue in our audience a little bit of what I'm talking about here.
For our clients that we've established financial plans for, that we've determined a target rate of return based upon how their money is invested in order for them to live off of it appropriately, we assume an average target return that we're looking to achieve over a long period of time.
Okay, so what's a typical number of that?
Call it 6.5%.
Okay, so when we create a plan for somebody, we'll project it out 30 or 40 years, and it'll have this target return of 6.5%.
Exactly.
And we actually print it right there on the plan too, don't we?
We do. And let me talk a little bit about where that comes from. The idea is if somebody has 50% of their portfolio in stocks and 50% in bonds, we've actually looked at and have kind of a little bit more scientifically evaluated how a portfolio invested that same way has performed historically. So the idea is when we calculate somebody's target return and ultimately figure out what that is, it's based upon historical data, not just what we think stocks and bonds are going to do moving forward.
That's a good point, because I think a lot of advisors, when they're looking at their capital market assumptions, they will go off a projected future expected return, which we think is frivolous and irresponsible. So what we've done is we've taken the data based on how we blend the investments, and we've gone back historically. Now, obviously, past performance is no indicator of future performance, but when you're dealing with a projected return, you might as well go off of what's historically happened. Right. So we use what's called a historical average when we're creating those targets. Okay, good. That makes sense.
And it's good to have a baseline, right? I mean, you have to have something to operate on if you're projecting into the future.
Right.
So we might as well use historical data rather than me just saying, well, you know what, Jake, here's what I think is going to happen the next 30 years. So let's calculate all our clients' plans on that. So with all of that being said, right, we have a target return now. You and I understand, and I've been having these conversations with clients more recently, which is kind of what sparked this whole conversation, is that making 6.5% per year every single year is not going to happen. Right. I wish it was that easy, but the idea is when we're calculating somebody's average return, we know that they need to hit that on average over a long period of time.
Okay, so let's go real world with it. So 2017, somebody that maybe has a target return of 6.5%, we may have made them, I don't know, 12, 15%, for instance.
Sure. Somewhere in that ballpark.
2018 obviously hasn't been a great year. And that return may look flat, right, or zero,
or even down,
right? So, what's a client to think when they don't hit that target rate of return of 6.5%? How would you guide them as an advisor?
I would help them understand that in the conversations that I've had recently, again, is last year in 2017, if your account made 12 or 13 or 14%. We didn't assume that you were going to make that return every single year, right? We know that the market's not going to go straight up forever. So at the same time, in 2018, in a flat to a down year of the market that we've seen, we're not assuming that, the market's going to go straight down forever either. So with that, the point really being, we need to evaluate how we're invested. We need to understand what we're invested in. But if you have a flat or a negative year, it frankly doesn't need to be a whole lot more complicated than looking at what the broader market has done. Because if the stock market's down 6, 7, 8, 9, 10%, depending on the day here recently, it wouldn't be wise to expect your account to be up 6.5% when the stock market's down 10%.
Right.
So the point there is, it doesn't mean that anything is wrong. It doesn't mean that you need to do anything differently. The point is you need to understand that your plan is predicated upon good and bad years because we're just trying to hit the average. I'm not going to go through somebody's plan and assume, well, 2019 it's going to be up 20%, 2020 it's going to be down 10, and so on and so forth, and just guess. We're trying to hit that average over the long term.
Right, that makes good sense. And I guess so that's the whole theme of our show today, is that Bad News Bears, is that we're going to have bad years like 2018. I mean, that's part of investing. Anyone that's been investing for any length of time knows that the market doesn't go in a straight line. I think what happens, though, is we as humans, we forget that, and fear and greed play a big role in our emotions. And so when the market is flat or negative and we have these volatile days, in the market, people get scared and they worry about running out of money. And so, I'd encourage our audience to just remember that we use financial planning as a huge part of what we do, but we use it as a tool. And it's not the end all be all deal, is that we can adjust these plans, we can run different scenarios. But the idea is that if we're trying to average a return over a 30, 40, 50-year time horizon, it's okay that if we underperform, at some point that average, and because other years will outperform it. Just like we have a really good example in 2017 and 2018. It's you can't get better than both.
Yeah,
of
it's
those.
almost ironic that those 2 years are kind of bookended the way next to each other, the way that they are.
Right.
It's not bookended, but back to back.
Yeah, no, I think it's a perfect example of how the markets work. Is that you can have years where the stock market's up 20%, and maybe your stocks were up 20 or 25 or whatever, and then you could have years where it's negative and they're down 5 or 10%, and that's normal. And I think it's good, frankly, that we've had them back to back, because it just reminds people that, hey, this thing's not going to go up in a straight line. I certainly need a financial advisor or wealth advisor helping guide me through these types of markets and paying close attention to our plan. And so a big thing that we do at Falcon Wealth Advisors that not a lot of advisors do is they'll meet with every client twice a year to review that plan.
Exactly.
And maybe you could talk a little bit about what you do in that meeting when you're looking at least performance in a bad year with a client and their plan. What's one of the indicators that you're looking at to make sure the client is still, that the financial plan at least is still healthy?
Right. Well, first off, we're looking at the long-term plan. That's one component of it, right, is looking at the actual projections for the future. But secondly, when we're evaluating...
So let's go into that. Let me interrupt
Okay.
you. So if you're looking at the long-term projection, what are you implying that, what I hear from that is maybe that means that the plan is still not going to run out of money? Is that what you're getting at?
Yeah, exactly. And I think we've talked about it on a previous episode where, the time to panic is when those long-term projections don't look healthy. It's not just because we've had a bad year in the market. And the point is, because the plan is predicated upon an average return, one bad year in the market shouldn't blow up the financial plan. It shouldn't completely change the way that the next 20 or 30 years looks.
Right.
Because we know that that's going to happen.
Yep.
Just like last year, we didn't change all of our clients' plans to assume that they make 12% on average. Right?
Exactly. And I think the key, though, is to remember as a client that first and foremost, you need to be properly diversified when you're looking at your plan. And second, your advisor should be able to rattle off all of the stocks and all of the bonds that you own. Because if you're in a product and it's negative and the advisor can't articulate why it's negative rather than just saying the whole market's down, that scares me a little bit. So with all of our clients, they may own stocks tied to gold, and gold may be up, and we can show them that this stock particularly is up, and then if they do need money, we can sell individually from the stocks and bonds rather
Right.
than using mutual funds or an index fund.
Yeah, exactly. And I think that's, again, kind of talking about, getting into the details. But I think the biggest thing from a high level is like what we were talking about in those review meetings. We're looking at, does your long-term financial plan still look healthy? Yes. Hopefully, yes is the answer. Okay, so that means we don't necessarily need to make any changes right now. With that being said, though, let's look at what's actually occurred. And it's easy right now to point out, this is what your account did in 2017, this is what your account did in 2018, here's the average of the two. As we have more data points, as more years go by, what we care about is that the direction of the portfolio and its performance is trending in line with the target. That's really all that matters.
Right. So the takeaway I think from this segment is we're going to have bad years in the market. There's going to be years where you don't hit your target return if you have a financial plan, and all of that is completely okay.
Exactly.
It's expected, actually.
And the reason I wanted to talk about this today is because I've had people ask me, well, my plan doesn't take years like this into account.
And it does.
And it does. But it's an educational conversation that we have to help people understand that. And that's why I want to talk about it today.
Well,
because I'm sure other people are wondering the same thing.
Yeah, absolutely. Why don't you talk real quick before we switch topics about baseball players' averages?
Yeah, exactly. It's you could look at somebody who's, historically, if you're looking at batting average, which we won't get too much into a conversation
Right.
about that, but if the average is how good somebody is in terms of getting hits, right? And if you look at their 10-year career, they might have, if they're a 300 average, which is a solid batting average over a 10-year career, they might have some years where they hit 350.
Exactly.
And they might have some years where they hit 240. But it's about averaging what they averaged.
Right, to get
over
them
a
in the
longer
Hall of
period
Fame,
time.
right?
Exactly.
So that's the same concept with your plan, is that with our clients, we want them to be in the quote-unquote Hall of Fame. We want it to be successful and never run out of money. And we're going to have years where we bat 350, and we're going to have years where we bat 250. And you can't blame your advisor for the market. What you can blame your advisor for is not being adequately diversified or knowing your investments or charging you too high of fees. Those are all things that are certainly in control. But to hit an average, you've got to know that you're going to have good years and bad years.
Yeah, exactly. And I think part of an advisor's job, whether it's you and I or anybody for that matter, is making sure that we're doing a good job of communicating that with our clients regularly, and then also with new clients before they come on board. It is our job to help people understand that.
That makes good sense. Okay, very good. So what about our second topic today? We wanted to talk about turning the knob a little bit towards more investing itself. What do we want to talk about with our audience today about that?
Sure. So we've kind of covered stocks at a high level, but I want to talk about income investing, and specifically, I guess with our business sort of being built primarily around retirement planning, a lot of our clients are either drawing income from their portfolios or they're preparing to draw income from their portfolios in the next couple of years. If I was a client of yours, and not even that, using that example, I guess my question for you is, how do you generate income in portfolios for your clients so they can take distributions regardless of what's happening in the stock market?
Yeah, that's a great question. And so we've talked about this briefly on some other shows, but Corey and I wanted to go into more detail. First, I'd like to talk about 4 ways that you and I do generate income. And then maybe even more important to that, I wanted to talk about how we set up clients' portfolios to weather bad markets. And I've got a chart that will show on that in there. And so... way number 1 that we generate income is through bond interest. Bonds are a big part of the portfolios that we have for our clients. And basically what we do is we buy bonds and they kick out 3, 4, 5%. They all have varying maturity lengths, and the income basically accumulates in the account if they're not retired, and it gets reinvested. Or if they are retired, it's part of their monthly distribution that we send them. Pretty simple, pretty standard across the industry. Another way that we generate income for our clients are through dividends, right? So we buy companies that typically have a history of increasing their dividends over time, and we take that as a hedge against inflation. And again, those dividends are normally paid out quarterly. And so what we'll do is we'll take those dividends as they come in quarterly, and if the client needs income, we'll send them income. If they don't, we'll reinvest it.
So you don't have, typically, somebody, if they have dividend-paying stocks, they're not automatically reinvesting?
No, not at all. We can customize that. So if they wanted to accumulate more shares with those dividends,
sure,
we certainly could do that. Like you said, normally our clients are retired or they're approaching retirement. And so we prefer to send those dividends out to them in the form of income.
Right.
A third way, which we talked about on our last episode 28, if you're going through our archives, is using covered calls. So basically it's a stock option strategy where we sell away potential upside in return for, you guessed it, more income. So it's a third way that we generate income. This is a little bit more unique. Certainly you and I didn't invent this strategy. No. I think any competent advisor that's buying individual stocks for their clients should be doing it, particularly if the account needs income. And then the fourth way, which we like the best actually, is in years like 2017, when the market's up 20%, we take that as an opportunity to rebalance our clients' accounts. So if they're in a 50-50 stock to bond portfolio, we may be 60-40 because the stocks did so well. We will go ahead and sell away some of those stocks and use that money for income in those good years. So meaning we don't have to necessarily use just the bond interest, but we'll actually use what's called appreciation.
So if clients last year were retired and taking distributions from their accounts, in all likelihood, they would have been drawing money from the stock side of the portfolio where that piece was appreciating.
Yeah, so the bond interest actually was irrelevant to our clients last year. In 2017, we were basically sending them appreciation. And then this year, they've been more reliant on their dividends and their bond interest and covered calls. And so it's a teeter-totter effect that we just want to be able to juggle. But the beauty is the way we do it at Falcon Wealth Advisors is we like to generate at least 3 or 4 different ways of generating income for our clients. Now, probably even more important than talking about that conceptually is in reality, we want to make sure that our clients have at least 5 to 10 years worth of income on that fixed income or in that bond portion. And what that allows for when we do have bad markets like 2018, they can pull from those bonds if they need extra capital. And so what will normally happen is, well, go ahead if you were going to.
And I think you're getting into it, but I was going to ask if somebody, maybe if they need an extra distribution and they don't have enough income getting generated, you don't have to go sell stocks when they're down and
Right. So the stocks almost pulled back 20% from their peak. It's certainly not a good environment to be selling stocks right now. But if a client needs to pay their property taxes, or they need to buy a new home, or fund college saving or college education for a child or a grandchild, we could peel off some of those bonds. And those bonds may be up or down, but they're typically going to be down far less than something like a stock, pulling back 20%. And so that's another opportunity. And that's why we like to keep 5 to 10 years worth of money on this bond portion, particularly for a retiree, with the whole idea that if we do have a bear market, or we do have a major pullback, or if we have a recession, that they have plenty of money over there to last them through that cycle. A typical cycle from peak to trough lasts 5 years. That's why we pick 5 years. And so we like to keep it 5 to 10. If they can afford 10, we certainly like to do that. But anywhere in that area isn't comfortable to us.
Do you know what is the consecutive record for the number of down years in the stock market in a row?
No, I don't know.
Do you know?
No, you're trying to stump me?
Well, I guess.
Do you know the answer?
Not necessarily trying to stump you. I think it's 3 or 4 years.
Gotcha.
In fact, I think it's 3 years.
Okay, which makes good sense.
So
I know it's never gone to zero.
Right. No, of course.
The stock market's never gone all the way down to zero.
Right. My point there being, and because I think it's good for people to be reminded that if you have 5 to 10 years worth of the money that you're going to need in bonds, theoretically you would need the stock market to go down for 5 or 10 straight years, which it never has, before you would deplete what you have in bonds.
That's a good point. And that's, again, one of the safety measures that we take for our clients, and not a lot of other firms do, frankly. So that's a big deal. And then we also know that the stocks, like you just commented on, are going to go up and down every single day.
Right.
And as they go up, we sell them and we buy more bonds, which does two very important things. One, it increases income because you're putting more money in income-generating assets. And two, it lowers your risk. So in years like 2017, we were what's called rebalancing. We were taking money out of the market, buying more fixed assets or bonds. So when you have a bad year like a 2018, you don't lose all that money that you just made.
So you're not just, buy and hold and ride it to the top and then ride it to the top.
Yeah, exactly. We don't do that. When clients call in, I like to think that we have very intellectual conversations about that and what we're doing specifically for them. A lot of advisors are just say, oh, it'll go back up. And sure, to some point that's true, but I don't think you're really adding much value to the conversation when you tell a client that. We like to go into detail and say, look, these are the assets that are generating income. This is how much money we have in bonds for these types of market events. And we're prepared because in the end, we're not surprised. Were you surprised by 2018? Not that you knew what was going to happen, but this type of market is normal. It's not like it's nothing we haven't seen before.
Right. I don't think that there was a specific day where I thought, oh, now the market's going to drop 20%. But if we think about where we're at now, it's no surprise that there was a year in the market where stocks went down because that's what they do.
It happens.
They just didn't do it last year.
Right.
And people get complacent, I think.
Yeah, and they definitely go up more than they go down.
Yep.
So that's an interesting point is to remember is that, that's why you're invested in the market, is that historically it has, gone up far more than it's pulled back. And it's called a risk premium. And you've got to be able to stomach and afford to stomach years like 2018. We get it. If you're retired and this money's got to last you the next 30 years and you're no longer saving, that can be a very anxiety-driven event. And so, we just pay close attention to that and we're very careful with it. Okay, now let's go to our question answer section of the show. Corey, what question did you have for me?
So the question I had for you was one that somebody has asked me about more recently, and their question was, if I have cash that I need to invest, or if I have cash where I've been waiting for a market pullback at this point in time, should I invest it now? Should I wait 3 or 6 months in case the stock market goes down more?
Yeah, so the big idea with that is it's a question of dollar cost averaging versus lump sum investing. We don't believe in dollar cost averaging. Dollar cost averaging is basically saving money over a prolonged time frame. The only way that makes sense is if you can't afford to invest your money in one lump sum. So if you believe the market is going to go up over the long term, our argument would be to invest that money as quick as possible because time is on your side. It's been proven the time value of money compounds. And so, again, to answer that question, I'd say no, you should invest all of it now as much as needs to be in stocks. You should not wait because you can't time the market. And so, again, we don't believe in dollar cost averaging unless that's your only option. The better way to do it is to invest now. So if you get a bonus, don't spread that bonus out over months in the market. Buy in immediately. And if you need to rebalance now. I don't know if the market's going to go up or down. Nobody does, right? But the idea is if you believe the market's going to go up over time, which I do believe, then it just makes common sense to invest that sooner versus later.
And especially, I guess, if the money that's going into stocks is not designed for you to touch for a long time, right?
Exactly. Yeah, it's a good point. So we just talked about how you want to have your short-term money, in bonds 5 to 10 years. It's another point. If you're going to have stocks for the long term, what does it matter what they're going to be priced at in a few months? It doesn't matter.
Right.
Okay, good. And the question I had for you that's been popping up lately, basically is, we talk a lot about buying individual stocks, how we believe in that for our clients. Does it ever make sense for an individual investor not to buy individual stocks?
Yes.
Okay, which is surprising because, again, we pound the table on how we don't believe in products. So when would you tell somebody not to buy individual stocks?
If that person didn't have enough money to diversify properly. In other words, if somebody is just getting started investing, or somebody just, funded a Roth IRA.
So our clients' children, typically.
Exactly. If somebody's just, funding a Roth IRA for the first time, and that's how they're getting started investing, and they put, $3, $4, $5, $5 or $10,000 in that account, for instance. And if we're going and buying 35 stocks and we're spreading, the money out evenly across those, you're not going to have enough to do that. So in that particular instance, I don't know if buying individual stocks would be the best way to diversify.
Gotcha. So how much money do they normally need to have then, do you think, to buy individual and stocks and bonds for that matter?
Yeah, that's a good point. I think if you are trying to diversify your stocks and bonds appropriately, I would say probably at least $100,000.
Okay, so what do we do for clients, or maybe I could talk a little bit about what we're building for clients that might not have 100,000. In the past, if your child is starting out, we certainly don't want to turn that away. We don't want to send them to a competitor that's just going to do something or sell them a product like a broker. So we're actually in the talks, in the works right now, building out a robo-advisor of our own. And it's designed for people that are starting out.
What's a robo-advisor?
A robo-advisor is basically something that's been built for somebody that is savvy enough to handle it online themselves. So it's basically an entire online platform that will monitor the investments in our same strategy, basically do the rebalancing and everything that I've talked about. But if they don't have enough money to buy individual stocks, we'll put them in very low cost exchange traded funds. Again, we don't like them, but I would much rather do that than just put all of somebody's money in one stock and risk them being under diversified. And that could end up creating more harm than good for them. So the idea is we're using it as a funnel to get people started. Once their accounts grow to 100, 200,000, whatever we think is appropriate for them to actually go out and buy individual stocks and be diversified fully, then we'll move them over. We'll flip them over and get them out of the product. But I think if you're starting out, if you want to recommend one of your children come to Falcon Wealth Advisors, of course we'd love to help them out. But we think using this robo or this online platform is going to be much better for them long term than risk investing in Google, and that's the only stock we can buy because they only have a few $100s or whatever, or $1,000 or whatever Google stock's trading at, versus buying 35 stocks like we normally would.
Yeah. Are there any other times that you can think of when it doesn't make sense for somebody to, if they have cash, when it wouldn't make sense for them to buy stocks?
What do you mean? Like if they have enough money?
Yes.
I don't know. I don't know why you would ever want to buy. I guess maybe to answer your question, there is maybe one instance. If you're not working with an advisor and you don't want to manage it every day, but you still want to do it yourself, then I think using a product makes sense. I think if you're working with an advisor, though, you should not be in products. I think it should be one or the other.
I gotcha. And I wasn't trying to stump you there.
No, it's a good question. It's a good question. So I think if you have enough money and you're hiring an advisor, you should not be in products.
Right.
And if you have enough money and you want to do it yourself, then you should use products. That's what they're for.
To diversify,
Yeah, that's what they're for. But if because it is a full-time job, I mean, we have an analyst internally at Falcon Wealth Advisors who's literally watching our clients' stocks and bonds every day, all day long. That's his sole job. He's not here to bring on new clients. He's not here to make balloon animals. I mean, he is here to analyze the stocks and bonds for our clients and try to make them the most amount of return that they can, taking the least amount of risk.
Right. And I guess I was thinking of it a little bit more when I asked that question. I'm glad you said that. I was thinking of it from an asset allocation standpoint, and that if you think you're going to need that money in the short term, I meant stocks versus bonds.
Absolutely. Well, then that goes back to our point earlier that you should have bonds and cash set aside for that. So again, stocks should be used for the long term. You need to make sure you have enough money to buy individual stocks, And if not, we can talk about low cost alternatives. But that's the idea behind that.
Gotcha.
And we're going to talk about this more and roll it out more. But I think it's something that we've been talking a lot internally about, and we just want to be there for our clients. But we also want to still act as fiduciaries and do what we think is in their best interest.
Right.
Because that's first and foremost. I mean, we can have our belief in buying individual stocks, but ultimately, in the end, if we're not doing what's right for our clients, then we're not really acting as fiduciaries. So we still want to do what's right. We want to keep costs low. We want to keep it transparent as much as possible, and then ultimately help them reach their goals.
Gotcha.
Okay, now for our fun topic, I like to stump you with. I know last year we did New Year's resolutions. I don't think I'm gonna do that personally this year. But I wanted to ask if you wanted to share in an effort of accountability any New Year's resolutions.
So I've been thinking a lot about this lately, and the short answer.
Have?
Yeah, I have. The short answer is they're not really finalized quite yet, but I mean at a very high level. I can kind of talk about some of the goals of mine. One is to, I don't mean this to be a bad word, but compartmentalize my time better. Not even necessarily when I'm here, but even in my personal time, and just making sure that I'm not, wasting.
So what, you got 30 minutes for Cassie, 2 hours for baseball.
Not quite that.
30 minutes to read.
I don't want it to be that quite that extreme. But I think that I feel like sometimes I will find that, for instance, like with our iPhones nowadays, I'll find that if I'm not here in the office, sometimes if I'm just, scrolling through Facebook or Twitter or whatever it might be, sometimes I hate to say it, but scrolling a little mindlessly. And then before I know it, it's like, that was 30 minutes that I probably could have done something else with.
So screen time.
Really, and being mindful of it. And I think something that goes along with that I suggested to Cassie last night, that I think she thought I was a little crazy when I suggested it, but what I talked about making potentially a resolution is no more using smartphones in the bedroom. In other words, either leaving it outside of your bedroom at night when you're charging it. But
what, do you get in bed and just scroll and scroll and scroll? Is that one? I don't really do that. I mean,
no, I'll look at my phone sometimes though. Maybe it's 10 minutes before bed, and I'll go and look at my email or I'll look at something else. And I don't think it's good obviously to be plugged in and to stay caught up on stuff, but I think that I don't think that our minds and our brains are designed for us to look at like a glowing screen right before you try to go to sleep.
That's a good point.
And I think, 30 minutes before bed, reading a book, for instance, is probably a healthier thing to do. So
good for you.
that's something I thought about.
No, that's exciting.
It's not set in stone. So
no, but we're going to hold you accountable, though. We're going to hold you
I know.
accountable. But again, I don't think I think I just want to live a healthy and happy life.
And I do too.
I want to keep. We have a greater purpose here at Falcon Wealth Advisors, that we're here to help people, and we want to be the best advisors in Kansas City, if not the country. And I just want to focus on that, and I want to focus on being a great husband, and hopefully a good father one day, and just living every day to the fullest that I can. But I don't know if I call that a resolution. That's where I already feel that way.
Yeah.
Now I don't need a resolution to do that.
Do you try to quantify that? I mean, I guess if you say, "Well, I want to be the best husband or the best financial advisor,"
No, I think it'll come. I don't think you can quantify it. I think an overall life satisfaction is a way to quantify it. If I'm happy or not, I think there's been times where I haven't been happy, maybe, and now recognizing that sure, you're gonna have bad moods or whatever, but if I can live my life with purpose, and I don't think there's a way to measure that really, other than I think a way to measure that would be the success of our business, the success of my marriage, anything else. But I think that'll all come. I'm not looking for an outcome. If that's your question, I'm not searching.
I guess that's it.
Yeah, I'm not searching for an outcome. My mentor has helped me tremendously with this. Is that I don't need X amount of more clients. I don't need X amount of more new revenue or whatever. I just want to be the best financial advisor that I can be, and I want to be the best husband that I can be to my wife, and I want to be the best business partner to you, and see what happens. I think the rest will take care of itself, but I'm not looking for some sort of end result other than hopefully positively impact people's lives. And if I can do that, I think I'll be okay. So again, that's another I'm getting deep on you, but
that's admirable. But ultimately, I was asking because, and I say this, almost a little tongue in cheek, so I can figure out how to hold you accountable in case I didn't.
Yeah, well, you just tell our audience that I've been grumpy lately, or whatever. I know, or whatever. But I agree. No, there should be accountability, and I don't know what that is, but so that's what I'm going to work towards.
That's good.
To work towards that.
And I think it's always this time of year is good to reflect on things that you feel that you did well, and areas where you think you need improvement. And there's something to kind of having that fresh start. But I think to your point, it doesn't have to be just because it's a new calendar year. If it's a lifestyle or a mindset, change or shift, that's something that hopefully is not it's not, trying to discipline yourself so much that, I can't go outside of this or I'm doing something wrong. It's just, I think trying to be a better person, right?
Yeah, absolutely. The best person I can be. Not even the best I can be. I want to be the best financial advisor. I want to be the best husband. That's what I want to do.
I'll let Rachel verify that.
Very good.
So I'll check with her. That's how I'll hold you accountable.
That's a good
I'll ask her.
point. She's a good one to ask on that. So anyways, thank you all for tuning in today. That's about all the time that we have. Again, you can find me on Twitter at JakeFalconCRPC.
And you can find me on Twitter at Corey Bittner KC.
We're certainly social out there, so please subscribe to our YouTube channel, like and follow us on Facebook, along with Instagram and all the other various social media platforms out there. Thank you again for tuning in. We hope you have a great week.